the end, I will tell you all. The last thing I will do is destroy every good thing I have done when I know things have changed. And how do people win in things like this? They ride up undervalued assets and they sell them when they become overvalued and move to another undervalued asset. But ask yourself this one question. Other than the central banks and the big money here, and you guys, how many of your friends could talk to you for 30 seconds about the merits of owning gold and silver? And is the only time they talk to you about it, if they know you own it, is when it falls in price.
That's it.
We are 4 days away from delivery with 239 million ounces in open interest outstanding as of yesterday. I haven't looked at it today, but there's only 88 million ounces in registered silver.
The silver market is hurtling toward a mathematical day of reckoning this week. As of late February 2026, open interest for March silver delivery has swelled to a staggering 239 million ounces. Yet official COMEX registered inventories have plummeted to a record low of just 88 million ounces. This massive 3-to-1 imbalance means the exchange is effectively naked against the tsunami of delivery demands. With the March delivery cycle just 4 days away, the paper-to-physical decoupling is no longer a theory, it is an active liquidity crisis. As Eastern exchanges continue to drain Western vaults at a record pace, the window to secure physical metal before a potential exchange force majeure is closing in real time. Joining us is Andy Schectman, president of Miles Franklin, who delivers a blunt warning about the great wealth rotation. Andy breaks down the reality of a market where the general public is completely oblivious to the collapsing debt system, only reaching out to mock gold owners when the price dips. He highlights the insane delivery numbers, noting that the big money isn't just buying, they are withdrawing millions of ounces physically from the system. Andy's thesis is simple. When the paper claims tower over the actual bars, the only way to win is to ride undervalued assets and move to safety before the paper Ponzi implodes. Now, we present the clips from his interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So let's look at what we see happening here. And this is not talking about gold, which I believe is the exact same thing, but different. But silver, for 16 months in a row, between 40 and 70 million ounces of silver have been delivered every month. Every month. Now think about this for a minute. A mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who takes possession of 70 million ounces of silver? How many trucks does it take to load that up, and where are they going? Every single month unabated, including non-delivery months. And ask yourself, why does no one talk about this? The media talks about the price and that it's overbought and that is it 2011 again? Is it 1980? All the shit to make you think you made the wrong decision. They miss everything. The only question that should be asked is, who's doing this? This has never happened before. Sure, there are deliveries. Not like this. Not massive deliveries, usually less than 1%. But here's another one for you. So for the February contract, which ends in 2 days, right? 3 days, on the 26th, the February contract, the way it normally works is that those who are holding contracts that are going to stand for delivery, the very first day that it posts, which would be the last day of business in January, they would say we're standing for delivery. But throughout the entire month, you can buy an immediate contract and stand for delivery. Now, here's what's really interesting. Check this out. You might even want to write this down. The February deliveries for COMEX, 4,639 contracts so far. That equals 23,195,000 ounces. A lot of silver that was delivered from wherever, London, Switzerland, wherever the hell it came from. It was delivered instead of rolling forward or cash settling. Remember, only 1% used to stand for delivery. The majority of the contracts that have posted in February are standing for delivery, not 1%, a hell of a lot more. Okay, that's a lot, 23,195,000. Not as much as we've seen in previous months because February is not a primary delivery month. January is, March is, May is. So, but here's the interesting thing. 23,195,000 stood for delivery so far, but 38,082,934 ounces have left COMEX. Left it. Where the hell did it go? Who took it? How many trucks does it take to take 38,082,000 ounces and drive it away? How many semis and to where? And why is no one asking? So if nothing else was understood tonight, if nothing else was understood, period, in the light of a market that got its ass kicked in 2 days in a manner that was so contrived, it's pathetic, who is spending this kind of money? And these people, 38 million ounces times $80 an ounce, do the math yourself, you're what, almost $3 billion, right? Who is doing that? Now, is it any coincidence, just like the BIS reclassified gold tier 1, after all these banks repatriated and then went on an incredibly large buying spree, way outside the realm of what was normal, is there any coincidence that for 15, 16 straight months it's been happening this way here? And it must be a coincidence that silver has now been classified critical mineral and that the government is putting price floors underneath it and they're going to accumulate a strategic stockpile. What you saw that happened when Kevin and I were away skiing, when the price collapsed, is one thing and one thing only. They jacked up the margin so high that all the people who are very well heeled, maybe even have $1 million or $2 million in their margin account, found out what happens when margin requirements go up exponentially, enough to make everyone say, I give, and have no choice but post more margin or sell, which begets more selling, which begets more selling, which begets more selling. And what happened at the very, very bottom? JP Morgan covers almost 800 contracts. But how about this one? SLV, that massive ETF, which changed the prospectus in February of 2021 during Silver Squeeze to say that there's a lag between the time that we accept your order and the shares are issued with silver backing it because it's coming in so fast. They did it on a Saturday night, that being BlackRock. Well, how about this one? 38 million shares were entered at pretty damn close to the bottom. How was a share issued? Share is issued when one of the authorized participants, JP Morgan, Goldman Sachs, Citi, deposits the silver. So they sell it at $110. Bang, they knock the hell out of it and deliver 38 million shares at $60. How does that work? But even more than that, now you have it inside of SLV in controlled institutional vaults where all these so-called authorized participants for the last 3 years have been doing what's called share redemption. Instead of taking delivery off of COMEX, they put the silver into SLV and then redeem the shares in the form of physical silver. It's opaque, it's invisible, blah, blah, blah. The point of it is that I want you to all to understand as we continue to go through this tonight is that nothing has changed. And in fact, the deliveries, there's one more thing to mention about the deliveries. So that was February, right? Let's look at March, okay? The March contract, and now this was as of a day or so ago, which goes off the board on the 27th, I believe, okay? Yep. So they, as of the other day, there was 47,847 contracts representing 239 million ounces of silver. That was the open interest. That was the amount of contracts that are out there that could stand for delivery. This late in the cycle, remember, most stand for delivery the first day. The others, there was 400 million a week ago. So some fell off, some was forced off, some rolled into the May contract because that's the next primary delivery month. So 100 million ounces disappeared, right? We are 4 days away from delivery with 239 million ounces in open interest outstanding as of yesterday. I haven't looked at it today, but there's only 88 million ounces in registered silver. Where's there a problem here? 239 that think they could stand for delivery against 88 million in availability.
So basically, if
it's almost
35% of the contracts stand for delivery, it will wipe out everything that's in COMEX.
And so I'm not calling for a wipeout in COMEX. That's not what I'm saying. But what happens, we see a market now that is in backwardation and has been for a while, meaning normally markets live in what's called contango. And that means today the spot price is less than the futures price because the futures price takes into account the time value of money, storage, interest, etc. The further out you go, the higher the price is. But now it's like saying, yeah, nah, I don't really trust you or your promises, so I'll pay more for it right now.
The recent price collapse, engineered through exponential margin hikes, appears to have been a contrived shakeout of leveraged speculators. At the very bottom of this dip, institutional giants like JP Morgan covered hundreds of contracts, while 38 million shares were suddenly deposited into the SLV ETF at a massive discount. This opaque share redemption process allows authorized participants to move metal from the public eye into institutional vaults with total privacy. As the market shifts into a permanent state of backwardation, where the immediate spot price commands a premium over future promises, the message is clear. The big money is no longer skating to the puck, they are taking the puck home. The paper Ponzi is hitting the brick wall of physical reality. Let's get back to the interview.
Now it's the biggest, most well-informed, right? Let's just say well-informed. Where is the puck going? Traders in the world, and those are the banks here in the United States, who have been told by this administration silver is worth more than the dollars that we are using to buy them. And all of you banks here in the United States, get on sides. And you can see that by the report by the Economic Times and the Commitment of Traders, who shows the banks in the United States are moving to net long. Like, they need to get really long, not just net long where you're a little more long than short. That's what this was about. It's going to come back. And that's what we see right now. We're in the aftermarket. We got silver right now.
Oh, it's
flat. It's at $88, but it's been a strong, strong.
Which to me, I mean, surprisingly, given the fact that we had the Shanghai market was closed for a week
tomorrow.
Right. So we had it closed for a week, which I was actually surprised that we saw such a rebound this week with Shanghai being closed. I actually thought
everyone thought it was going to collapse.
A big dip. And I actually held off on a couple of buys that I wanted to make for some clients, thinking that it would dip. That's my wrong.
Well, and see, this is where the sophisticated traders play the market. It's called, well, what would it be called? I guess it would be called, I don't even know what you would call it, really. I guess it's painting the chart, but they know exactly what people think. The conventional wisdom was that because
following the sheep, following the herd,
because the conventional wisdom said, well, Shanghai's closed, the market will get pushed around. This is when they'll do it. Just so happened to go higher. In other words, they know what conventional wisdom says. And this is why for so long people are like, well, it's so maddening, because intuition, logic, conventional wisdom, these things have been inversely correlated to the metals market because they have been manipulated. And now it's not just manipulation, it's more than that. It's trying to eviscerate, I think, or that's not the right word, extricate themselves from these positions that are which will eviscerate a company or two or a bank or two on the wrong side of this, but to extricate themselves from these positions that have been, I think, they've been called out, and the world understands what they being the Western banks, have done to suppress and control the price of gold and silver. No one stood for delivery, but now we see extraordinarily large delivery requests. That's how this system ends. And you know who called that out before anyone was Jim Sinclair. He said, stand for delivery. There was a financial advisor I did a lot of business with in Minnesota who followed Jim Sinclair and told all of his clients to stand for delivery on COMEX, and they all got 100-ounce bars. And he switched them all into coins, but he followed Jim 20 years ago, who was saying the only way to beat these players is to stand for delivery. And I always figured they were too big. And for us, they are, but not for Russia, India, China, Saudi Arabia, and the rest of the sovereign wealth funds that work on behalf of these governments around the world. But someone got to Trump and said, this is happening. We need to do it too. And when you see this kind of volume coming into COMEX and leaving and nobody talking about it, that is not by coincidence. I'm talking about it and will tell you it is 5 feet of snow in Death Valley in in August. And should that happen next August, I promise you, you will not see snowmobile dealerships popping up in Death Valley. That's what these kind of deliveries and metal leaving the exchanges are. Please take a deep breath and understand price is the greatest tool of misdirection. The fundamentals separated from the emotion, which in and of itself is an entire school of investment theory, wave theory, Kondraty, Avenelli, of the human emotion, controls the market. Step away from the herd, step away from the emotion, and see the logic. And just remember, the people who are bringing in 9 figures every month since a year ago, November, without missing a beat, do not fuck around. They know where the puck is going, and they're doing it while misdirecting the emotions of even you guys who are gold and silver bugs, questioning, is this the end? It's not the end. And I'll tell you one more thing. When it is, in my heart, the end, I will tell you all. The last thing I will do is destroy every good thing I have done when I know things have changed. And how do people win in things like this? They ride up undervalued assets and they sell them when they become overvalued and move to another undervalued asset. But ask yourself this one question. Other than the central banks and the big money here, and you guys, how many of your friends could talk to you for 30 seconds about the merits of owning gold and silver? And is the only time they talk to you about it, if they know you own it, is when it falls in price?
That's it.
Yep.
100%.
So are we late? Hell no. It's still very early. The public is still blissfully asleep as it pertains to this.
Market expert Andy Schectman returns to explain why painting the chart is the ultimate tool of misdirection used to confuse even seasoned gold bugs. Andy emphasizes that while the public remains blissfully asleep, the smart money is riding undervalued assets and standing for physical delivery at rates never seen in COMEX history. He draws a powerful parallel to Jim Sinclair's legendary advice: the only way to beat the manipulators is to take the metal home. As sovereign wealth funds from Russia, India, and China drain the exchanges, Andy warns that the system is reaching an August snow in Death Valley moment, a fundamental impossibility that is happening right before our eyes. Logic dictates that when the world's largest banks are told that silver is worth more than the dollars used to buy them, the end of the paper suppression era is here. Share your thoughts on this analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.